All right, good afternoon. It looks like everybody right now is connected. Welcome and happy hot July if you're here in the Texas Panhandle. I think this is one of our last hot days for the week. It looks like next week's going to cool down. So stay inside and watch the webinar and learn about financing. It's a really good day for that and probably hot in Lubbock as well, Jason. Welcome everyone. My name is Gina Woodward and I am the Regional Director for the Small Business Development Center at West Texas A&M. Obviously, we are right here in Amarillo and our office works with small business owners all across the Texas Panhandle. We're either working with you one-on-one to maybe help you start a new small business, or if you have an existing small business, we can help you manage that better or even expand it. We do a lot of work with you one-on-one, things like business plans, cash flow projections, loan applications like you're about to learn about, market research, anything that you need that would help be a tool to help you grow and support your business is what we're here to do. Thankfully, we are funded by the Small Business Administration and the state of Texas. So you don't always get to see the impact of your tax dollars, but you get to see it here because there is no charge to you to work with us. If that's something that you might be interested in now or at any point, please feel free to shoot us an email and you'll have our contact information in a follow-up email after today. I want to welcome one of our very favorite partners, Jason Bigham with Capital CDC. Jason is joining us live. I think he's in Lubbock, although it does
Yeah.
not look like Lubbock. They don't have quite that many trees there. Jason is a lender with Capital CDC, and I think you even serve a larger area than we do here in the Panhandle. You
Right.
have all of West Texas, right?
Yeah, I'm here in Lubbock and I cover West Texas as well as Eastern New Mexico.
Very nice. So he stays very, very busy. This is the second year that Jason has been kind enough to do this webinar with us, and it has been a hit. It's been one of our best attended webinars during and then the post previews. I think it's something that applies to a lot of our small business owners. You know, Jason, we do a lot of that one-on-one work with people, and this is probably one of the most intimidating things for them that they work on. It's really not as bad as a lot of people think it is. And so when you're able to sit down with us and show us step by step, this is what we need, but also this is why we need it, it really helps to demystify that process. So I appreciate it.
Good.
So I will stay on, but I'm going to turn off my video so that Jason can share his slides. As he goes through here, and if you have questions, and you probably will, please feel free to type those into the chat and I'll keep an eye on them. Jason may choose to address them as he goes. After each session, I will take a break and ask you questions, and then we'll address the rest of them at the end. So take it away, Jason.
Good. All right. Thanks. So you do see my presentation is up. All right. Well, let's get started. Um, my name is Jason Bigham. I'm with Capital CDC. We're a certified development corporation. We are headquartered in Austin, Texas. I cover a territory that includes West Texas and Eastern New Mexico, as I said a moment ago. We are a statewide certified development corporation covering all of Texas. Plus, we're actually multi-state, I should say. We also cover New Mexico and Arkansas. But I am here in Lubbock and have been with the company for over 15 years. We Capital CDC is, when I say Certified Development Corporation, that we're a CDC, that means we're certified by SBA to administer the 504 loan program, which is SBA's loan program for small businesses that are owning and occupying real estate. That's not all the small business loans that can be done. There's lots of different ways to finance your small business, but that's the thing that we specialize in. So perhaps in the future, if your business is acquiring real estate or developing a property or wanting to refinance real estate that you already own, then that might be something that we can help you with in conjunction with a local banker. But what we want to talk about today is, you've got your idea for a small business and you're interested in moving forward. You're not sure though what the financing entails. It's we often say most people the biggest loan they'll ever get is their home loan. But for small business owners, that's probably not true. You can very easily get a much larger loan than a home loan for a small business. So but it can be an intimidating process. And what I'd like to do is just kind of go over the basics of the loan application process and a few of the major components there so that you understand why they're being requested and what the and the best way that you can go about kind of preparing yourself for the task of going out and obtaining financing for your small business. All right, so you got an idea for a small business. You're certain that it's going to be a success. It's an idea that no one else has come up with in this market or that you think you can do better. So, what comes next? You got to put a business plan together. Gina was just talking about it. That's the thing you go to the SBDC for if you're not confident in putting one together yourself. You go to the SBDC and they will help you. Um, you want to put a plan together that includes the following information. You want to tell what are your products and services? What kind of business is it that you're going to start? Who are going to be the people running your business? This is very important to the lenders out there. They really want to know who's involved. It really is probably even in some cases more important than the business itself. They want to know about the people that they're talking to. How are you going to carry on business operations? What are you going to do? Are you going to, is this a retail store where you're going to rent space? Is this a manufacturing company where you're going to need to build a building specially to manufacture this? Are you going to open a restaurant, a hotel? You're going to, whatever it is that you're going to do, it needs to be understood clearly, how you're going to carry on your operations. What is your target market? Are you just looking to hit a certain section of, let's say, Amarillo or Canyon, or are you going to be doing business throughout the whole city? Are you going to be statewide? Are you going to be national in scope? What is your target market? What is your marketing and sales plan? How are you going to go about reaching those people? Is it just going to be, you just going to put up a website? Are you going to do advertising? If so, is there money for advertising? You'll need to include that in the budget. Who are your competitors going to be? What is the state of the industry right now? Some industries, this is easier to find out than others, but the SBDC can really help you with that. They know and have sources that can tell you about different industries and what the competitive set might look like in your target market. That's a really big benefit and something that a lot of people on their own don't necessarily know how to get to. Um, what are your income projections? What or if you are looking, if your business is already up and running, what do your financials look like? Um, this needs to be uh, pretty in depth and include detailed assumptions. If you're doing projections, then you need to give us detailed assumptions about how you're going to create that income, how you're going to generate that income, and why you think you're going to be able to generate that income. So just because you're just going to open and people are going to walk in the door because your product will be irresistible, or are there things that you can point to that say, hey, we don't have a certain franchise in our market, and our market's friendly to franchises, and they do a lot of business here, but this one doesn't exist, and I've got the chance to get this territory and do it. Excuse me. Stuff like that. We're going to need to know, what are the assumptions? And then if you're doing a franchise, they will often help you put together those projections. All right. So business plan, it's mandatory. You got to have one. You could go into a local bank and say, hey, I want to start a small business. And they're going to say, cool, let's take a look at your business plan. If you don't have one, then that's where the conversation ends. You've just created an impression that you're really not prepared for what you're doing here, and you're going to have to go put one together. So really, this is good advice. Go put one together ahead of time, and really the SBDC, since you can access their expertise for free, and they want to help you. They want to create jobs. They want to help you put something together that's going to succeed. A lot of times, the way that they'll help you is they'll tell you you're not really ready for this. So you gotta Go get some outside expertise. The SBDC is a perfect place to go. Get that business plan going and pretty tuned in, and make sure that they've helped you kind of go through it and that it looks like it's a viable project before you start calling on lenders. An exception to that might be you got a ton of cash. You got all kinds of cash sitting in the bank, then your banker's going to be happy to see you and he'll just give you the loan because he knows that you've got the cash in the bank. He's going to make you personally guarantee it. He's going to keep a tab on those funds that are in the bank, and you're not worried about whether the business fails because he knows you'll pay back the loan anyway. But that's not really the way you want to approach this. I think you put that business plan together, go see a banker, show them that you've got your act together, and you'll find that you're going to have some better financing options. All right, so let's talk a little bit more about projections. This is a basic worksheet that we use and that we will share with people that they can so that they can put together a set of projections. It kind of looks like uh, a financial statement, an income statement, right? We've got income up at the top, where what we're doing here is going, this is year one, months 1 through 12, and then a total. Doesn't have to start in January. You might open in May, and so it will go May through April, and then give a total for your first year of operations. What are your sales going to be? What's your cost of goods sold? That's an accounting term. If you don't know that, again, the SBDC will help you with that. But it refers to, the cost to of the stuff that you're actually selling. What's your gross profit? What are your expenses? Do they include salaries, rent, cars, supplies, advertising, everything? It's all in here, a lot of it. There may be more. Your specific business may require you to go into more detail than this and include information on specific line items that might not be in other businesses. Uh, Inventory, for example, if that's something, if you're going to be selling stuff, if you're going to put together a retail operation and you're going to sell things, then inventory is there. Um, and it goes all the way down, and then you're going to come over your total expense, whoops, plus, and then gross profit minus total expense equals net profit, less whatever owner's draw there might be. And this is cash available. And we look at that over the course of a year, and then we total it. And we are actually going to want to see a couple of years when we get started on a new project. And that's what I recommend you put together. 2 years of pretty detailed monthly financials. And then down here, answer these questions. They should either be answered in your business plan or in a separate, maybe a separate document they should be answered in your business plan and perhaps on a separate document that's attached to the financials. How are these sales determined? Where'd you get the cost of goods sold? Where'd you get the expenses? Are you basing this on experience? Is this just what you think? Is this based on an estimate for similar square footage buildings from the local utility provider? Where did you get it? The more detail you go into, the better it is, and it just again shows that you're prepared. The SBDC will also help you compare your income figures to the figures of similar businesses in the same market area, the same industry. You'll be able to, so you might go in saying, well, our expenses are only going to be 20% of our income, and we're just going to make a ton of money. And the SBDC will help you say, well, look here, it turns out for most businesses like this that income and expenses are closer to 45%. And you might, you might need to take that into consideration. So they'll help you come up with not only a business plan that looks nice, but that really addresses a lot of those questions up front. Okay, how are you going to market your business? Written description of other pertinent facts, plans. That again, that's kind of what we're already talking about in the business plan. All right, so we want you to go into some detail on the projections, and you shouldn't view this as a chore, right? As a hurdle. You should view it as an opportunity, right? This is your chance to put your whole vision into writing in the narrative portion of the business plan and into numbers here, data, right? You're giving people something that they can look at and examine and again, the more detail and the better researched your numbers are and your and the better your narrative is and your description of the business, the better chance you have to succeed. Before I go on, do we have any questions? Anybody want to ask a question real quick as what I've covered so far before we start talking a little bit about financial statements?
I don't see anything in chat, Jason. I will just
Nobody
add,
good?
I'm
Okay.
glad that you brought up those metrics. That is research that we can pull and show industry standards for your industry, but not just in general. We can pull it by geographic area and gross sales as well. So if you're a local coffee shop, we don't have to compare you to Starbucks.
You bet. Exactly. Good point. All right. So this is good to know too, not just for the loan process, but for your own process. Um, if you're going to own a small business, you should get comfortable with financial statements and with what they are, and how to use them to understand what you're doing, and certainly how a bank will use them. This is another bit of training that the SBDC will give you. They also, a lot of SBDCs, do you guys have it? Gina, do you do accounting classes and how to use QuickBooks and stuff like that?
We do. We have a QuickBooks class, and then Shane also twice a year leads a profit soup cohort where people can really learn how to use their statements to manage strategically.
Yeah, really good stuff. Basic accounting is not too difficult to get a grasp of, but it does require a little bit of study. So let's go over some real simple stuff right now. When most of the time when a banker says, "Show me your financials, show me your financial statements," what that banker means is they want to look at your balance sheet and an income statement. This is a balance sheet first off. Balance sheet's very simple. You hear people use well, the concept is simple, right? But this doesn't look that simple, does it? Um, but it's going to show on one side you've got assets, on the other you've got liabilities, and then you've got the leftover, which is the balance. The two sides of the balance sheet, on the left assets, on the right liabilities plus equity, should balance. You'd be surprised. A lot of times they don't. We'll get those, and that's a sign of a someone who hasn't worked with financial statements much before. It doesn't mean you have to go hire a CPA for every little thing. You can learn how to use QuickBooks and how to do basic accounting on your own. But let's just talk a little bit about what goes into a balance sheet. On the left side, again, assets. They go from top to bottom in order of basically how liquid is the asset. The most liquid asset is cash, right? It's a dollar that you have in your hand that you can spend right now, right? If an ice cream truck comes down my street, I can run out there with cash and exchange my cash for ice cream. That's totally liquid asset. Cash can be spent right now. Cash in a bank is the same thing. And so that's what we're talking about here. Cash 2100 is probably cash in a bank. Petty cash might be cash that's on hand at the business. Don't worry about temporary investments. Accounts receivable is another kind of asset. That's like a bill. That's service that you've done where you haven't been paid yet. So you have an account receivable. You send somebody a bill for $500 and now you're waiting for them to pay you. That's an account receivable. You've also got, and as you see, right, that's not quite liquid, is it? It's not cash. It's cash that you're owed, but not that you have in your hand. Inventory, same. You've spent it and now you have it, but you haven't converted it into cash yet. So you haven't sold it. You've also got supplies, other things that count from an accounting standpoint as assets like prepaid insurance. Great. That'll go down monthly as the term of your policy expires. The business may have some investments as well, and then it has more what we call, so these are all short-term assets, current assets. Cash is the most current, accounts receivable, inventory, all that. Now we have long-term assets, property, plant, equipment. So the land, that's valued separately than the building. But we got land, we've got improvements to the land, like, paving or landscaping. We've got buildings. You've got equipment that the business owns. And then as you'll see, once you get into owning a small business, there's a lot of tax advantages for the small business because in our country, we really promote the starting of businesses. And so we give small businesses favorable tax treatment, and that's you get to deduct from your uh, taxes, or you get to deduct the value of you get to depreciate any equipment that you own and real estate as well over time, and that kind of reduces your tax bill. Then there's other, so we've got fixed assets, long-term assets, and then there's intangible assets. These are often not as much as people think they are, but there is goodwill. Coca-Cola is a brand that everybody knows. Coca-Cola has a ton of goodwill out there. There is the value just of Coca-Cola. Um, Disney, other well-known, you know bunches of them. There's some brands that have a lot of goodwill associated with them. The trade name, the value of a trade name, that's something. Okay, but for most small businesses, they're not too worried about goodwill. What we're really looking at as lenders is how much cash do they have? What do the accounts receivable look like? Is that under control? Like we don't want to see, right, that you've got $1 million in accounts receivable and only $100,000 a month in sales. That shows that you're not collecting your right. You're not collecting your bills. You're sending bills out there and people aren't paying them. That's not good. So we focus on cash, accounts receivable, those type of short-term assets. We look at the long-term assets as well. Not too focused early on, especially on goodwill and the value of the going concern. So there's all these assets. They're worth 770,000. So now we know that liabilities and equity must equal that, and so we start to add it up and see if they do. On the liability side, it's the same as the asset side. We go from short term to longer term. Current liabilities, notes payable. That's a loan that you have to make payments on. Accounts payable. These are just like they're the opposite of accounts receivable. These are accounts where you've bought things and now you owe somebody. You got to send in a bill or you got to pay an invoice. There's wages payable. People work for you and you're going to have to pay them soon. There's interest payable, things like that. Taxes, warranty, okay. Unearned revenues, total current liabilities, 61,000. Long-term liabilities, like a note payable, say your business borrowed maybe a small business loan, right? That would be a note payable. Bonds payable, we don't see too many of those, but we do see a lot of real estate loans. That would be more of the more a more typical long-term liability that you might see on a small business balance sheet. So really assets 770, total liabilities 481. Okay, and then we have stockholders' equity. Generally, we're just going to go 770 minus 481. Okay, equals about 289. Right? That's the net worth of the company. You figure up your own net worth the same way. You say, what's the total value of all the stuff I own minus the value of all the stuff, minus the amount of all the stuff I owe, and that's my net worth. Your accountant will get into these when you do get up and running, there'll be, we'll talk more about retained earnings and common stock, but generally we're going to do a pretty simple version of this and just go assets minus liabilities equals what, and that's what we're going to refer to as the net worth or the equity that you have in your company. On the income statement, that's also called a profit and loss statement, P&L. So someone will say, show me your income statement, show me your P&L. What do your P&Ls look like over the last 3 years? What are your P&Ls? How did your profit and loss from 2024 compare to 2023? Something like that. That's how the bankers will look at that. They'll say, give me your year end for 2024 and give me a year to date for 2025. All right, so here is what we're looking at. Here's an income statement for the period ending, and this financials need to tell you this. Up at the top, they'll say the name of your company, which financial you're looking at, in this case, a balance sheet, and what date does it cover. If you don't have the date on there, it's meaningless. It doesn't help anybody. You have to know the date. Here, same thing, name of the company, um, income statement for the 5 months ended. So it's important to know what period are we covering? Is your business on a regular calendar fiscal year, meaning, your business has a year over which it does business. If that's its fiscal year, and that's what it's going to pay taxes on. Most businesses, that's a calendar year. Your fiscal year ends on December 31st and starts over again on January 1st. Some businesses, for different reasons, our company, for example, we have a fiscal year that starts on October 1st because we align with the federal government, and that's when the federal government fiscal year begins. So, uh, something to keep in mind. So, we want to know if this was a fiscal year beginning October 1st, it would actually say for the 8 months ended May 31st, right? Because the fiscal year begins on October 1. So, it's it's important that you see that information there. And here we see the basics. This is a very basic income statement. Sales, minus the cost of goods sold, gross profit, minus the expenses, operating income is what's left down here. Doesn't include uh, loan payments yet. And then we have these other operating expenses, so and so. There's your net income. There's lots of different ways to put together an income statement, but basically we want to see how much sales did you have, what were your expenses? What was the basic profit that you made over this period, whether it's a month or a year to date or a year end, and then we'll compare it to previous years. I'll pause there for a second. Any other questions on balance sheets or P&Ls? I'll say you should. It is like we've said a couple times. SBDC is going to put on workshops from time to time, help you learn, quicken, probably as your business gets up and running. If you're starting it because you want to make a living at your business, and it's going to be important that you handle things correctly, you will probably at some point want to engage the services of accountant, at least a tax preparer, if not a bookkeeper, if not a CPA, to help you with that stuff. But you don't need it from the very beginning. They will also help you. As your business gets up and running and is more and more successful, CPA will be able to consult with you and advise you on, smart decisions to make for your business. All right. So your business plan is amazing. Your financials are ready. What's the next step? Before you go see the bank, this is very important. They want to see a personal financial statement. That's what PFS means, personal financial statement. This is a basic, what we call Form 413, which was SBA's version of a personal financial statement. Banks use something similar. They'll call it I think it's 1003 is a Freddie Mac form. Um, it's got several aspects to it that we're going to look at here. But the more complete you can be on this, the better it is. At the very least, pay attention when you're filling this stuff out. Fill it, and it will give you an electronic version. You could also do a quick search. Um, just go SBA Form 413 current and find the most current one, download it, and you can download it from SBA website. You'll be able to get an electronic version that you can fill in yourself electronically and then print it out and sign it and send it in, turn it into a PDF that you can email around, something like that. Let me give you some advice on filling out forms. Pay attention. All right. Be careful with what you're doing. Don't misspell stuff. Don't, go double check what you've written. Make sure that you give the full amount. Put, name, first, middle, last, business phone, home address, city, state, zip, the name of your business, the address, if it's going to be different than your home address. What type of business is it? Is it a corporation? An S corp, which is a different kind of corporation, an LLC, a partnership, or a sole proprietorship, which just means you, Jason Bigham, DBA, you know, Bigham Enterprises, something like that. Whatever it is, that's which means that I haven't formed an entity for it. Needed mark that appropriately, and then say the information is current as of, and you'll be able to drop down a menu here and choose the date. And it goes back to kind of like those financials. For us to be able to tell anything infer anything valuable from your financial statement, we need to know what date we're talking about. Are you married? And then you fill it out. And it's, as you note here, this is nothing but a balance sheet, right? It's a little bit simpler than the balance sheet a business might use, but it's the same thing. It goes from short term to long term on the left for assets, short term to long term on the right for liabilities. And then you see that there's a total, we'll go total assets here, total liabilities here, net worth here, and then the total. So you're looking, we want it to balance. The total here should be equal to the total here on the left and the right. And then, and so what we're asking for here is how much cash you got, right? You can pull up your bank statements to find that out. What in checking account and savings accounts? Do you have any retirement accounts? Do you have any notes receivable? Is your cousin paying you on a note for some money that you lent him? Do you have life insurance with a cash surrender value? This is not a term policy where you're covered for $1 million and you're just paying per month for that for 10 years. That's not what we're asking about here. What we're asking about is what they call whole life or kind of traditional life policy, where over time you pay into the policy and it accumulates value, and you can actually exchange that for cash at any time, if you like. It's a type of investment. We also want to know, do you own any investments like stocks and bonds? How much real estate do you own and what is it? We'll get into more detail on that. Notice that these each of these lines refers to a different section for more detail on whatever that line item is. How many cars do you own? What are the value of the cars that you own? What is the value of your personal property, your furniture or jewelry? Other things like that, and other assets that you have, maybe interest in a partnership or a business. And then you've got accounts payable. What are the debts that you have to pay? Installment accounts on your cars, or on real estate, any loans that you've taken out against that cash value, life insurance, mortgages, things like that. Unpaid taxes. Okay, most people wouldn't list that, but you can. And then you can go give more detail on those in the sections that follow. Here we want to know a little bit about your income. What's your salary? Do you have investment income or income from real estate or other? What are your liabilities? We want to know uh, um, what are you liable to pay? Did you co-sign a student loan? That's a contingent liability, right? Even though it's not in your name, you'd want to put it there. Give us and honestly, a lot of times people ignore this stuff and they'll just fill out the assets liability section. And okay, we can work with that to a certain extent, but the more information you give is going to be more helpful in most cases. Here's section 2. So it refers here to, notes payable to banks and others described in section 2. Well, here it is. Here's section 2. Tell us about those debts. We need to know this because we're going to do a calculation to see how much money are you making. We want you to be making money, right? We want to know that this business is going to generate enough income to pay its own bills, and then for the income that flows to you, for you to be able to pay your bills too. So we need to know what those are. We also want to know, about your income. Maybe you're going to start the business, but your spouse is going to continue to work the job that they have at a hospital. That's good income, and so that'll need to be included, and so that we can give you credit for that. But what do you owe? What's the value of any stocks and bonds that you hold? And you can add on to that and attach it if you need to. Tell us about real estate that you own. Again, you can add on to that and attach that if necessary. Um, this is all important to be able to calculate, what is your monthly nut? What's your monthly cash flow requirement in order to make money and be solvent and keep, making progress? Do you have any unpaid taxes? It's an important thing. If you've got a tax liability, this is an important thing to note. You've got a tax liability, and you take care of that. And you take care of it before you go looking for financing for your business, because it'll probably come up sooner or later, especially if you're going to need an SBA loan. Because if we look and see early on in the process, not we as the lender or SBA when we send it to them. We are not SBA, by the way. Um, but when we send it to SBA for review, one of the first things they're going to do is run your social security number against their database of unpaid federal taxes. And if your name's on that list, you're done. And we can't necessarily find that out up front. So we need you to be, honest with us and tell us about this. Go take care of it if you need to. What other liabilities do you have? Tell us about your life insurance, and then you'll sign and date it here. You can fill it out, print your name, and do everything electronically, and then print the thing, sign it with your signature, and then convert that into a PDF or a document that you can take with you. So there's personal financial. Again, any questions on that? Cool. You will often hear, and you can look this up, go do an internet search on YouTube for 5 C's of credit. And there'll be hundreds, at least dozens. Sort them by the ones that have the most views and look at them. Those guys will explain to you things about the 5 C's of credit. What are we talking about? Character, capacity, capital, collateral, and conditions. Plus, I'm adding debt coverage ratio. Um, Most of this is pretty self-explanatory, right? Character. Well, how do they determine your character? Well, have you ever defaulted on a loan? It's going to be a problem if you have. If you have though, and you've been a good citizen since then, it's overcomable. You're not dead for the rest of your life. But if you've ever declared bankruptcy or had major credit issues in the past, well, those have ramifications. And when you go to apply for a new loan, they're of course uh, gonna run your credit. And a lot of people would include credit as a separate C. Well, let's just include that in you know character here. So character/credit, if you will. So they're gonna run your credit report. That is a number that's gonna basically say, here's how John Brown has done paying his debts in the past. It'll take a lot of things into consideration. It's a little bit of a mystery, but generally, if you pay your debts on time, and that's really the about best advice I can give to anybody who wants to start a business is make sure you pay your debts on time. Um, Up to this point, and if you haven't, go get right with whoever you haven't before you come looking for more credit, because lenders will see, and if they see, look, this guy he went bad on a business loan, or he gave his home back to the lender 5 years ago. We're not going to, we can't take a chance on that. Banks are very concerned with risk. They don't want, they want to make loans, but they don't want to make loans if, uh, if there's a chance that reasonably ascertained that you may not pay them back. And they especially don't want to make a loan somebody that has weak credit, because then if there is a problem, then their bosses are going to say to them, what were you doing? Why did you do this? This guy only has a 580 credit score. That's bad. Why did you make a loan to him? So everybody wants to do well at their job. Bankers are no exception. So they're going to want to see that you've got decent character/credit, and credit is the number that kind of tells a little bit about your character. Don't worry if you've got there's lots of apps right now where you can determine what your credit is. We're looking for a number of like FICO score of 650 or better. We start to get more comfortable. Between 650 and 680, we're going to require an explanation, because if your credit is that low, there's going to be late payments on your report probably, or you're going to have over too many credit accounts out there. So we're going to need some explanations for that. Hopefully you're in the 700 range or better, and then it becomes a little easier to just accept, okay, this is a person who has made good on their obligations in the past. So it really might be the best thing for your small business if you pull your credit, find out, I'm in the 620 range, figure out what you can do to either settle some old collection accounts or um, uh, go back if there's something on there. Look, there's a lot of identity theft that happens, and we understand that sometimes it can happen to somebody. So but that's still, it's going to be on you to go back and call the credit agency and say, this is not right. I dispute this charge. And maybe go back to the creditor that's put that on there and figure it out. Sometimes it happens, you move and somebody misses your change of address form. They send you a medical bill and there's a delay in getting paid and they send it to collections right away. And that's a ding on you. Well, you can straighten that stuff out pretty quickly. So there are ways to correct your credit. Gina and the SBDC will be able to help you with that also. They can give you good advice on how to improve it. But really, the best advice if you've got poor credit might be fix it first so that a lender's going to be willing to take a chance on you. They're also looking at capacity. Do you have the ability to take this on? If you're working full time and you're going to start a yogurt stand and you're going to work it part time and on weekends, well, they'll be asking, does he have the capacity in terms of personal time and is can he or she fit this in with what they're doing? Um, uh, Also, it has to do with your financial strength. Capital, do you have the money set aside? You may have a lot of capacity. You may have a lot of cash sitting there that shows that you've got the capacity to make this project happen. Um, or you may have a strong, let me back that up. You may have a strong net worth because, your home's free and clear, but yet you may not have much capital. And so that sometimes there's a difference between those. Do you have the money to make the thing happen? Um, you can get with a 504, if you've got an existing business, you can get up to 90% financing on a building. Even for a new business, you can get 85% financing. Most banks are going to do conventional loans, that is without SBA, and they're going to max out in the 65 to 75% range, right? In terms of loan to value, right? The amount of the loan compared to the value or the cost of the asset. They're going to want to see that you've got enough money to put down to make the project happen. So if you're saying I want to do $1 million project and I need to borrow 850,000, okay, I should be able to look on your balance sheet on your personal financial and see that your cash up here is going to add up to 150,000 or more, probably more like 250,000 because we want you to be able to have some money to make the business run and for living expenses as well. So um, we'll want to know that you've got that together. Is there any collateral for the loan? Some small business loans, there's not. And the answer may be no. And that's not necessarily a killer, but it changes the term of the loan. Generally, in lending, we want to match the term of our loan with the term of the useful life of the asset. Okay. You see this every day, right? Those of you who may have bought a home, what you probably either looked at or did get a loan with a 30-year term, right? Home loans, you can get up to 30 years. But if you go buy a car, what are you going to get? For a new car, 5 or 7 years, maybe 5, 6, or 7. For a used car, 3, 4, or 5. Why? Because the useful life of the asset is much shorter for a car than it is for a home. So for a home, it'll retain value for a long time, so you can get a 30-year loan because even after 30 years, that house will have value. Of course, a car won't have value after 30 years, not if you're actually driving it. So what is the appropriate amount? Well, probably 5 to 7 years for new and 3 to 5 for used. So that's why those are shorter term loans. And if your small business loan, like let's say you're only taking out a loan you need it for working capital, you need it for inventory, you need it for a franchise fee, maybe that you're going to be required to pay. Well, these are all legitimate business expenses that a small business might incur and need financing for, but they don't have any value, right? I can't foreclose on your working capital, on your inventory, really, right? Let's say we did a little shop in Canyon where they have board games. Well, I can't foreclose on board games as a lender, right? That has no value for me. So all that means is you can still get financing, but it's going to be for a shorter term. But even for small business, in most cases, we'll give you 10 years for those types of assets, for assets that don't have any residual value. But if you're financing real estate, then on our side, we'll go up to 25, and most banks are the same. Also, what are the conditions? Is this the right time? Look, Gina and I were discussing. I grew up in Ruidoso, New Mexico. They're undergoing bad flooding right now. And a sad thing about that is that this is going to cause lenders to look at them and say, uh, is now the time to be financing a business in Ruidoso? Hopefully, the answer is yes. We've done some. I know that banks there are going to try to keep on supporting that economy, but things like that, of course, when COVID happened, there were problems. There were problems for some small businesses where, if you're trying to start an ice cream shop and in your state they've shut down all the ice cream shops, then that's a problem. That's an extreme example, but we're going to want some verification that the conditions for the business are good. Lastly, I want to talk about debt coverage ratio. That goes back to our projections or our financial statements for the business. What we want to see is we're going to and in this case, we've got interest expense and what we're looking at is probably operating income. We want to know that this business has enough operating income and makes enough money to be able to pay its debts and have some left over. Technically, in our program, we're legally allowed to accept a debt coverage ratio as low as 1 to 1, meaning that if the business has $100,000 in loan costs per year, as long as they make at least $100,000, we're okay with that. But the truth is, we probably want it to be better than that. We're going to look for a 1.25 or better. Our loan committee will. Most banks are going to do something similar. Maybe they'll go down to 1.1, 1.2. But what that means is that for every 100,000, let's say, in loan costs that you have per year, we want you to be making 125 in profit. And that's before income taxes, depreciation, or amortization. Well, another term might be what earnings before income taxes, depreciation, and amortization, EBITDA. People will call it that, net income, NOI. There's different terms for it, but we're going to do our own calculation and come up with net income is what we call it. And we're going to compare that to what your loan payments are. And we want to make sure that it's at least, for our purposes, at least 25% higher. So we want you to make money. We don't want you to just be scraping by. And that's something that banks are going to run real quick. They're going to say, okay, well, show me your financials. If you've been in operations for a few years, they're going to say, oh, show me your financials. Let me see those. And then they're going to run it their own calculation. They're going to see what your tax return showed in terms of income. And then they're going to add back some things like that, taxes, depreciation, uh, and then they're going to look at what that number and compare it to your debt payments and make sure that you're making enough money to service your debt and continue on. What's a problem is, of course, if it's less than that. You got $100,000 worth of debt payments, but your projections are only showing, or your historical financials only show that you've made about $90,000, then that's a problem, right? You're not making enough to cover your debts. And so perhaps a refinance might be part of that solution. Maybe you need to recommit and put more cash into the business. Who knows? But that's going to be an alarm that goes off. That's going to be a red flag for the lender. Loan options and terms, basically, loan to value means if you're buying something for $100,000 and you're going to get an $80,000 loan, you're at 80% loan to value. You may be familiar with this term if you've ever gotten a home loan. That's an important term in home lending, loan to value, LTV. What is the loan term? That means how long before you are required to pay this loan back. Some loans they pay themselves back over the term of the loan. If it's a 25-year term loan, then over 25 years, it'll just self-amortize or pay itself back over the course of the loan. So it's a 25-year term, but there's also terms that are shorter term loans. We call them bullets or balloons. If you have a 10-year loan, if you get a real estate loan and it's amortized over 25, which means that's the term upon which the payments are based, which that determines how much principal and interest you pay with every payment. And the longer an amortization is, the longer it takes you to repay the loan, but the smaller your payment will be. So the payment on a 30-year loan is at 8% is going to be less than the payment of a 25-year loan at 8%, and maybe less than a 25-year loan at 6% or a 20-year loan at 5%, right? The amortization is very powerful. So if you've got a 25-year amortization and a 10-year term, that means that after 10 years, you're going to be required to repay that loan in full and refinance or go get another loan. So be aware of that. Not every loan is fully amortized over 25 years. What's your rate? Of course, you want to know how much interest you're being charged. How often is that calculated? Is it an adjustable rate or a fixed rate? Our company specializes in long-term fixed rate loans, but a typical bank might give you, you'd go in and they'll give you you're buying a building, they'll give you, you're a startup, so they're going to give you 70% loan to value, meaning you've got to come up with 30. And they're going to give you a 20-year loan that's due in 10 with an adjustable rate based on prime plus 1%. Well, prime is 7.5% right now. 1% of that is 8.5%, but prime goes up and down. So if prime adjusts, if prime gets lowered, great, your loan payment goes down. If it gets increased, though, your payment goes up. So you got to be aware of that. Also, know what a guarantee is. In Texas, a cool thing about living in Texas is if you own a home, there's the homestead law, and that says that a lender can't pursue your home to satisfy a debt, say on your small business. You can look more into the specifics of the Homestead Act. I don't mean to give like serious legal advice on that, but most lenders, we know that if you got equity in your home, well, that's great and that's good. That shows that you can live for cheaper, but it doesn't necessarily mean in California, they can pursue your home. They can go get it. They can foreclose on your home and sell that and use that to pay off the debt. Lender in Texas can't necessarily do that, but you're still going to put up a guarantee. And that means that you're promising to repay the loan and that other assets that you own can be liquidated, including the business. So if you're buying a building for your business and then something happens and you can't repay that loan, then the guarantee is going to mean that the lender can come foreclose, they can come take over the business building and then sell it to repay their debt. So a guarantee is important. And in Texas, most loans require personal guarantees. In some other states, again, I had some of my career in California, non-recourse loans are not unusual. I mean, because, and those are loans where you might only just have to give back the property and they won't come after your retirement accounts or other assets. But a guarantee is a meaningful thing here in Texas, especially. It's a promise to repay, but know that your home is generally not included in that. Okay, best practices, put your best foot forward. Do a complete business plan. Make appointments with your lenders and try to get a warm handoff. Gina and her staff will be happy to tell you who the best small business lenders are, the most active ones in town. And do your homework, get your act together before you go out there looking for financing. And that includes making sure that that you know what it is and that you are prepared. Don't write something on the back of an envelope, say, hey, we had this great idea. Everybody loves my cheesecake. So we decided to open a $3 million restaurant and think that you're going to get anywhere. You just won't. You're just going to waste the lender's time and you're going to waste your own time and you'll have to go through these steps eventually, but now you'll be starting a little bit further behind. So, be aware of things like that. Don't go in there with a desire to know what they're looking for and not waste time. And that shows that you're serious and, no, it's a cool time now. You don't have to look a certain way And I'm here to tell you, there's lots of assistance out there. There's lots of reasons that banks and small business lenders want to help whoever comes in the door. I deal with a conservative bank in Abilene, and they're more than happy to do business for a tattoo parlor. And that lady is covered with tattoos just about everywhere on her body except her face. And she's working on her face. But so you don't think you have to look a certain way or necessarily have a certain background. It's not true. These lenders want to do business. They're here to do loans, but they don't want to do bad ones. And so you got to help them believe that you're going to be a good risk. And and the best way to do that is just to show that you've researched your market and that you've understand the basics of what they'll be looking for, that you're respectful of that, and that that's what you're giving them to review. It's kind of all I've got for now. Any questions as we wrap up?
Thank you, Jason. You do have one question in chat.
Great.
Uh, Robert has asked, where can we check if we have any unknown tax issues before we submit a loan application?
Hmm. I'm actually not sure of that. Um, you
You,
might check with with the SBA office in Lubbock. They may have someone where but even there, I'm not sure they can check that database. Um, Gina, do you
I,
have, maybe you can offer?
yeah, I mean, I would say on our end, one of the biggest places that you need to check is with the state, and that's going to be through the state comptroller's office because they collect all taxes. We can send you a link to that when we send the follow-up email.
Yep.
On the flip side, with federal taxes, that would be through the Treasury would have that record. I'd
Yeah.
never searched
U.S.
that.
Treasury. That's a good call.
Yeah, and I mean, if you have past due federal taxes to the Treasury, it's probably something that you're going to know about. They generally don't let you forget that. But we'll see if we can find you a link where you can search for that. The Treasury generally keeps that information somewhat private, so you may have to individually request that. But on the flip side, with the state, if your business has any past due taxes, they generally let people know that. That's usually open to the public.
Yeah. And you should know kind of similar on your property taxes, right? If you've got a home loan and you don't make your tax payment, most of the time home loans require that you let them make your tax payment and they'll collect that from you every month so that they can do it. But if you don't have that, maybe your home's free and clear, maybe a house, sometimes it happens. You inherit a home and it's free and clear, but the address was wrong. The tax bills were going to the wrong address, and you get upside down there, you get behind there. You can go check. Every county in the state of Texas has a central appraisal district. Go just enter a Google search for Potter County Central Appraisal District. Every one of them has a website. They all work the same. You can look up your property and it'll tell you what the tax status is if you
Yeah,
haven't paid your property taxes. But federal, I think the Treasury, yeah. And there it might too. If you do have an accountant, maybe check with your accountant, ask, hey, how can we check this out? But probably the Treasury is a good, US Treasury is a good place to start.
good call. We'll send links to those when we send that follow-up email.
Okay.
One more. Okay. One thing that I'll just add to this, I always appreciate you doing this, Jason, from the applicant standpoint. Just remember that Jason is the one who has to go to bat for you in front of the committee. He doesn't always get to make that final decision. Lenders have their own portfolios, and their jobs literally rely on the performance of those portfolios. So, as Jason's putting that together, and if he is, or any other lender, is asking you questions and you may feel like they're getting a little bit nosy. I always tell my clients, remember, Jason and your lender, they know the kinds of questions that that loan committee is going to ask. They're asking to prep themselves so that they can go to bat on your behalf. So always be very forthcoming with them.
I think that's good advice. Really, I want to say it again. we want to make you loans. There's no group that we redline. There's no group that we say, we're not gonna, we look harder at some property types, some business types. We're very careful with hotels, for example, because they're
Mhm.
so expensive and they're just as much a business as a piece of real estate. But we have public policy goals that it, it doesn't necessarily lead to free money or a lower rate, but it is a benefit when we make loans to businesses that are owned by women or minorities or veterans. That is a public policy goal, and that means it makes it a little easier for us to do the loan because we don't have to count the jobs. Normally, when on our 504 loans, we are counting jobs. That's really what we're here to do. That's what SBA is here to do, is uh, they make loans to you because they're trying to create jobs. They want your business to get up and running so that there's going to be jobs created, people working as a result. And I'm telling you, we've done businesses where we've got recent immigrants, and let me deal with that right now. Right, with the administration, you've heard a lot about immigration and some controls that they're trying to put on there. Legal immigrants are allowed to get SBA loans. If you are a legal permanent resident, um, and not a conditional legal permanent resident. Some of the green cards are conditional, some green cards are more permanent. But if you're a legal permanent resident, we can get you an SBA loan. Um, the it's a pretty good market for that. All right, they're considered on the same level as citizens, and I've done it in the past. We've had legal permanent residents from China, we've had them from Mexico, we've had them from other countries. It's possible, and uh, there's no the only types of businesses that we don't want to fund. I think SBA is really only limited by a few. We want your business to be a for-profit business. We don't do
Mhm.
nonprofits, right? And we really, of course, we want you to be a profitable business, but we're not here to do nonprofits. So, like United Way or a church, we don't do loans for them. We don't do lenders. We do some pawn shops that lend, but we want to know that they've uh, at least more than half of the income needs to be from non-lending sources.
Mhm.
One we just did it there in Amarillo, Bomb City Armory, the former uh, I forget its previous name, but that was one we did here not too long ago in Amarillo. So we can do some lenders, but like a bank is not eligible for an SBA loan because they're mainly lending money. A car lot that lends a lot of money more and that where they generate more income from lending is not going to be eligible for SBA financing. Besides that, it's businesses that are, in general, we would say featuring performances of a sexually prurient nature. We're not going to do gentlemen's clubs or that type of thing. SBA also doesn't like the restaurants where they've made that like a focal point, like a Twin Peaks or a Hooters. We don't do those. But other than that, you know,
Pretty open.
there's lots of businesses. You got a gun store? Yep, we do a lot of those. RV park? Yeah. Ice cream shop? Okay. Bookstore? No problem. Coffee shop? Yes. Some people might think our deal in Canyon that I mentioned, right? It's a little game cafe where you go in and you'll rent a table and you can play board games there that they rent to you. That's a cool little business. Some people might think, what? I had to explain to people what it even was, and we financed it. So we're really not looking to. Well, all we want to do is not make a really bad decision, and so as long as you've got decent credit and you've got some cash and you've put together a good business plan, then and it looks like you know what you're doing here, there's a good chance you're going to be able to get a loan. It's pretty great in this country how available capital is for people. Doesn't mean everybody gets it, but it's not there. I can tell you firsthand, there's no lists of people out there that can't get loans.
Yeah, we are very fortunate here.
Hmm.
So I mentioned to
Anything else?
y'all that Jason's webinar is always one of the most popular, and I know that we are over on time, but we have a couple of good questions that I'd like to
Great.
address. If those of you who are on, I understand if you need to get off, you will still get the recording afterwards, and it will include these questions. So you're not going to miss out if you need to get off. But Jason, if you have just a few minutes, do you have time to address a few
Yeah,
questions?
sure.
Okay. John has asked, what do you feel like are the biggest hurdles for small businesses just starting and applying for loans? They're not proven, but they've got a business plan and maybe 5-year projections.
Well, there needs to be some financial capacity there. I mean, you have to, 100% financing is not available. 90% we can get you in a lot of circumstances, even for loans that are mainly for, smaller loans that are for working capital, inventory, stuff like that. We can get between 85 and 90%, but you got to have some. You need to save up a little cash before you do this. People always want to know. I'm sure Gina can tell you how many times people come in and ask about grants. And there are maybe some available,
You.
but not many. You've got the capacity and the wherewithal and the knowledge and to start up a great, AI related company. Well, there might be an angel investor out there who'd love to get going with you if you've got that background. But for most, just the most of the small businesses, the ones that are most often financed by SBA loans are restaurants. Would you believe it? Either franchises or non-franchise restaurants. So you're going to have a little bit of cash saved up and something in your background that shows that you can that helps them understand that you've done your homework and that you can make a run of this thing. Hope that's helpful.
Very good answer. Oh, very good answer. So the last question is from David. And so David, I'm gonna assume probably works for a university or is either an inventor, and he has asked about his chance of getting loans while he's working with the National Science Foundation on an SBIR proposal. Are you familiar with SBIR and SBBR?
No, what is that?
So, and I'll help address this. So it is a program run by the federal government, and I believe there's seven federal cabinet level agencies that participate, and they award funding to small businesses to pursue the commercial development and commercialization of products that the federal government could potentially use, but could also be commercialized in private industry. So David obviously has some idea that he is working on and would have received federal funding. I'll address it from my standpoint, David. Ideally, the federal agency has granted enough funding that there should not be an additional loan needed. That's part of their goal. They want to make sure that that R&D is done thoroughly and completely, because it would be a waste of their time and money if they only fund like half of it. If by some chance they did not fund all of that, getting a traditional commercial loan, I would say would just be next to impossible at that R&D stage, just because there's not anything tangible to offer as collateral at that point. There will
Right.
eventually be some intellectual property once that's done, but by then, hopefully, the funding agency has already fronted all of that. If you're at the point where maybe you've kind of done some of the R&D, but you're getting ready to take it to market and that's where you need the funding, it would still be a little bit tricky just because of the collateral issue. That's a point where a private investor, they would look at that very, very favorably. So it may be either an angel investor or a venture capitalist, but without collateral, somebody like a Jason or a traditional bank likely could not touch that. But Jason, I don't want to put words in your mouth.
I think that's a good answer. I mean, we're kind of here to do regular, everyday, on the street businesses, right? You're a local doctor's office, a local restaurant, a bowling alley, a hotel. That's the kind of stuff that we finance. Um, if you're hooked up with or you're part of that, you know, a bigger research foundation, then maybe there's a different way there. We're not here to do we want to finance businesses that are we kind of require you to show that you're going to be making money in the first year. We
Mhm.
want to know that you've got a chance to to get out there and make an economic impact, however small it is, but appropriately for the scale of the business within the first year. We're not here to finance R&D or that type of research. No matter how great the idea is, that's just not our. We're just here to do regular, everyday small businesses. As Gina mentioned, venture capitalist angel investors, which, by the way, are that's not debt. They want equity. They want ownership in your
It's
business.
not free, is it?
Yeah, so it's a form of debt in a way, and who cares if it's you sell for $5 billion and you only get 2 billion, and they get 3? Well, then hey, it was all worth it, I suppose. But that's not really. We're not here to bet on small businesses that might do well, even though, well, I mean, I just said that, but we are, but it's just on a strictly debt
This would be
standpoint.
much too early for a traditional lender,
Yeah,
yeah.
yeah. Research, R&D type stuff. We're not here to provide capital to keep you to develop the product as much as we are to, we'll help
Right.
you buy the machines to make the stuff that you're going to sell once you get the machines. But um, it, it doesn't sound like that's it. Maybe there's better places for you to get financing for that.
And we've got some, thankfully, in Texas, some really great angel groups and venture capitalists as well. So
Sure.
you need help with any of that, David, definitely reply to that email that we'll send afterwards. All right, well, I appreciate everybody hanging around. Jason, anything else that you'd like to add?
I don't think so. No, I appreciate it. We'll be happy to help if I can. My number was at the beginning, and just give me a call. I'll be happy to answer any other questions.
Perfect, and we'll include that and all of your information in that follow-up email as well. Well, I
All right.
appreciate everyone being on board and sticking out with us. I hope that you learned a lot. I know I always learn something new every time I sit in on this, so thank you, Jason.
Appreciate it. Glad to be here. Thank you.
Wonderful day.
All right. Bye bye.